December 2nd, 2024. Today was a pretty tight day and it ended up only having a range of 16, 18 points ish. So pretty small day. So I guess sometimes that'll happen coming off of a holiday. And the prior day, well, the prior day was a half day, but the half day was a bull trend. So you can see we got a bull trend and then a pullback, basically starting from this bar 39 to this bar 19, and then a weak bull channel, higher high, higher low, higher high, higher low. So you can still see the market cycle manifesting: spike, pullback, and then bull channel, but obviously a bit weaker today. Bar one, a bull bar with a big tail on the top and a big tail on the bottom. Two, an inside bar, a bear bar closing near its low. It's possible opening reversal. So theoretically, some traders would sell below two and hope that we basically get a collapse to the downside and it's a giant bear trend day. But it's really not all that great. Another thing to keep in mind is bar one did something pretty important, and that is it triggered the signal on the monthly chart. So the buy signal bar on the monthly chart, the high was 60.60 because that was the close of last month's high. And you can see on bar one, we traded above that. In general, when you trigger a signal, a buy or a sell signal on the monthly chart, the market will usually pull back first before it goes in your direction. So I think that most traders were expecting a bit of a pullback once we got above the prior day's high. Some traders, like I said, could take the short below two, but you're probably going to be disappointed with your follow through. Quite frankly, most of the day was not very good trading. And if you didn't trade today and you basically just sat out, especially, depending on where you are in your career in trading, these are days that can be really tempting to take a lot of trades and try to take a lot of reversals. But, if you sat out of this today and basically all of this today, I think you did a really good job. You should pat yourself on the back. If you did end up taking a lot of trades in here or in here and lost some money, I think that's fine too. It's just a part of the learning experience, and you will definitely, get to the point where you can successfully sit out of those. But the thing to keep in mind is you have to wait for follow through. And I know what you're saying. You're thinking, well, this is a bull bar and this is follow through, and this is a bear bar and this is follow through. And you're not wrong in thinking that it is follow through, but it doesn't break out of anything. So that's kind of the problem with selling down here or buying up here, is you're buying with big risk at the top of the trading range, or you're selling with big risk at the bottom of the trading range. So how eager should you be to do either one of those things? Had, both of these bars were one, I was one bar away, one good bull bar that closed above the high of one away from buying. However, we didn't get it. And if we had gotten another good looking bear bar closing below the low of 6, I might have sold. But again, we didn't get it. So that's the thing with these sorts of days, is the market will often get close to breaking out, but never quite do it. So 3, buyers below 2 during 3, a large tail on either side. So you have to expect some traders starting to buy back shorts, at least for a little bit of a bounce. 4, a bull bar. Again, if you were disappointed with 3, a lot of those traders bought back shorts, and that causes 4. An outside down bar on 5, but a large tail, not really worth shorting anything. Follow through 6. 6 is a high 2 buy. So 3, high 1, 6, high 2, but a large, it's basically a giant doji bar. So do you really want to buy above this? No. Do you really want to sell above it? Probably not really. 7, a doji bar. So sellers above 6 during 7 initially, and it's possibly 3 pushes down. 8, an inside bar, probably buyers not too far below, probably sellers not too far above. A bull bar on 9, a tail on the top and the bottom. We have a 3-bar ledge, 7, 8, 9, meaning we will probably get back to that price at some point. But really the important thing here is we're in a tight trading range. And the extra important thing is to not be eager. You shouldn't be super eager to take a trade at this point in the day. But the worst thing you can do is just get chopped up on these days. And then, you have a trend day, whenever we have a trend day this week, assuming we do, you make a bunch of money on that day, but it just ends up making up for your losses on these types of days. So it's okay on days to be very defensive. And, trading is, you have to change your mindset. It's like sports. You can't always be on offense. Sometimes you have to play defense, and it's the same mindset with trading. Sometimes, there are definitely days where you need to be, really aggressive and it's your type, whatever your type of day is, right? If this is your type of day, then this is the day to be aggressive. But I'm more speaking out of my perspective. I only took one trade today. Well, I took 3, but I traded a stock as well. But the trade I took on the Emini was I bought the close of 63 for a measured move, and that was the only thing I did today. I stayed out of everything over here. And for me, this is a defensive day. I see this and then a breakout and it fails and it looks like a trending trading range. We have a lower trading range here and then an upper trading range here, which is the hallmark of a type of trending trading range. You could argue it's 3 pushes up, but I put it more, I gotta put it in the trending trading ranges category. But I can just go through a few examples and just show you guys what I'm talking about. The lower trading range here, the breakout, the upper trading range. Not a perfect example. Lower trading range, breakout, upper trading range. A lot of times the breakout only lasts 4 to 5 bars. This is today. Upper trading range, a breakout, 4 bars, bear channel, but really then just a lower trading range. And you can see, this is a good example. Trading range, 4 or 5 bar breakout, upper trading range. So we were essentially forming that sort of pattern once we got that other breakout. So again, I think it's really, really important. Really important to learn when to play defense depending on the way that you trade. And for me, this is a type of day when I see us start to go sideways, I get really careful and I'm more worried about playing defense than I am about playing offense on this day. 9, so I did 9, 10, a bear bar. It's possibly a third leg down, first leg to 3, second leg to 6, third leg 10, so 3 legs down. Then 11, a bull bar closing near its high. Do you buy above 11? You know, it is 3 pushes down, but you're probably buying the exact middle of the trading range. The problem with buying 11 is if you're buying the exact middle of a trading range. One, that's the big one. And the big problem with it, I think, is that if you're taking trades like this, you're probably going to end up taking a lot of bad trades as well. So it's really difficult to take that trade. 12, follow through, consecutive bull bars. Good for the bulls. We're probably going a little bit higher, but I'm not sure how much higher. 13, another bull bar. So 11, 12, 13, 3 straight bull bars, expecting a second leg up. But the pullback could be deep because it is trading range behavior. You do have to wait for a breakout. And you do get the second leg from this. You could argue that it's 15 the tail, but it should get a better second leg. But we might go below the low first. So once we traded below this low, traders bought more and then used the second leg up. So 14, disappointing, a doji bar. So a lot of the bulls who bought the close of 13 were hoping that 14 would race up, look something like 20, and instead it looks like this. So they use 15 to sell out of their longs. And that's what causes the bear bar on 15. Or yes, on 15. 16, a high one for the bulls, hoping to start the spike, pullback, and then bull channel, but not really all that great. 17, an outside down bar, a tail on the bottom. Again, it's a good looking bar for the bears. It's a little bit of a surprise, but it's not really all that great. 18, follow through, large tail 17, large tail 18. So possible parabolic wedge, down 17, up 17, down 18, up 18, down 19. What does that look like to you? It's a kind of crude drawing, but it's 3 legs down, right? So when you get 3 legs down, you have to be expecting at least 2 legs up. 20, a giant bull bar. It's big enough for me to expect another leg sideways to up. So if we trail back to the bar 19 high, you should expect buyers at the bar 19 high. 21, disappointing follow through. So buy the close bulls 20, probably disappointed with 21. However, they're still expecting a second leg up. So they're willing to scale in probably around the 19 high. 22, bull bar, but large tail. Probably going to get still a second leg up and expect buyers below 3 bar micro channel, 20, 21, 22. Buyers below 22 during 23. And then bull bar, inside bar 24 with large tail on the top and the bottom. Probably sellers scale above scaling and higher. Probably buyers below scaling and lower. Is it okay to be long here? Yeah, but is it, A plus to be long? No, it's not, because it's still trading range behavior, and 17, 18, and 19 will limit the upside. 24, an inside bull bar, like I said. 25, another doji bar. 26, a bull bar, a large tail on the top. 27, more follow through, so going at least a little bit higher. And then 28, another bull bar is possibly a second leg up. This rally, 3 straight bull bars is not enough for me to buy. My trading system is more 4 bars. You see, I'm just going to mark this bar because I'm going to go on a little bit of a tangent about it. But we had 3 bars here. I don't trade 3 bar micro channels because they're a little bit less reliable than the 4 bar micro channels. I just decided, since my system only gives me like 1 setup a day, I decided that I could also trade a singular stock, and I just picked the stock to trade at random. I picked Tesla just because it's volatile. There was really no particular reason. I just know it moves, and it doesn't move necessarily in congruence with the Emini. So that was basically my qualification: is don't move like the Emini, because then it'll just offer the same entries. So I want it to be a little bit different, and I just picked Tesla. So I'm going to day trade the same entry on Tesla, and obviously it has the same problems. Price action is the same on all timeframes, but bought the close of 33 today. And then I bought the close of 71, and I thought it might be kind of a mistake because if you're going to trade like a buy the close, sell the close system, it's usually difficult to do it profitably at the end of the day, especially if it's a trend day. So if it's like a bear trend, or if it's a bear move, or a relatively flat day, it's okay to bet on an upside or downside, or an upside breakout if it's a bear move, or a downside breakout if it's a bull move to some extent. But 69, 77, or 68, 69, 70, 71, hard to buy those closes because it's been a bull channel all day and you're betting on an explosive breakout. But I did also buy the close of 71 today, and I got out during 76 below that. So I took a full win on this and a full loss on that, and a little bit worse, small loss on that today. And obviously I traded the mini and I did okay on that. But anyways, 29, an outside down bar, probably buyers below 28, and then 30, a bull bar closing near its high. This is a high probability buy below after 5 straight bull bars, or 5 straight non-bear closes, and a micro channel, buyers below 29 during 30. Probably going to get another leg up. 31, 32, consecutive bull bars. But look where you're buying. 1, pullback. 2, pullback. 3. Pretty clear third leg up, so not that great. 33, an inside bar, probably buyers below, sellers above. 34, again, it's a wedge top, but it's not that great. And then 35, a bull bar, outside up, but bulls are hoping for a breakout above the wedge. Probably not going to happen. And 36, big bear bar. Do you sell below 36? Yes, and no. So I know, very clear answer from me, obviously. But is it wrong to sell below 36? Probably not. But it's really not that great because it just doesn't usually get great follow through. And the channel up from bar 20 to bar 35 is tight. Think about it. If you're selling below 36, you're probably a little bit anxious about it, meaning it's probably not a very high probability trade. And if you do take the short, you probably want 37 to be a big follow through bar. And what you should do instead is just wait to see if you get follow through in some sort of successful breakout. 36 is big bar, big risk. So it's really just not that great to take the sell. I know it's tempting. I think it's a tempting looking sell anyways, because that's the type of trade that I used to take. I trade a specific way now, but that's the kind of trade for maybe the first 2 or 3 years that I traded that would really, really, mess me up. And then I would end up exiting above, bar 37 for a decent loss. And you just really can't do that if you're going to take the sell. So if you take the short, do you really want to sit through all that sideways move and then you get the breakout and the breakout fails? Probably not. So I think it's better to just wait for the breakout and see if you get follow through. And then again, once you get into here, you should stop taking stop order trades. This isn't worthy of a stop order. This isn't worthy of a stop order. It's better because it's a failure. But the reality of selling 48 is that 47 is strong enough to get a second leg up. And the reality of buying 47 is that, you're buying high in a tight trading range. You're buying this high. It's the top of a tight trading range. It's a ledge, right? So right here, the traders have sold the past 3 times and you'd be buying that price. Again, the really important thing, especially in areas like this, is to just not lose money. So just don't do anything. Then you eventually do get the breakout 57, but disappointing, and starts to fail. And then we get the upside breakout for 3 legs, 1, pullback, 2, pullback, 3. And this is technically a signal for me, 72, but I was in the trade on Tesla, so I stayed out of it. I considered just staying out of both and just, being done for the day, but I decided to take one of them. And anytime you're trading a third leg up, it's not great. Third legs at the end of the day, not great. And again, I think the whole thing was a big wedge, 1, 2, 3. I wrote it in my notes, but the trade, the price action was decent. So I did end up getting in, but I think that, this is a trade with time. I'll stop taking. I've already filtered out some of those bull trend buys, but it's really hard to on days like this because it's hard to call it a bull trend. Anyways, for stop order trades today, buy above 20. That's really it. I mean, you can buy a little bit later in the day, but there's not really a lot of good looking stop orders on the day. So not really that great of a day. For limit orders, they're everywhere. Buy below any bull bar, sell above any bear bar, scale in. Works best. These 3 bar micro channels, they're good on days like today if you do the opposite. And I don't necessarily mean selling the close of 13, but I mean instead of buying the close, you buy below with a stop and measured move down, and this is your target. So instead of buying here with the stop here, on a day like this, you buy here with the stop down here. But I think that it's better for most traders to just stick to stop order trading, because the reality of most of these limit order trades, nothing in here is worth trading. And you can buy below 63, that's high probability. You can buy below 28, but 63 is better since first leg up, and this is a second leg up. So if you're going to take buys below, like buying below 22, you generally want to trade the first leg. So buying below things on the first leg and selling above things on the first leg is probably what you want to do. You only want to do it if that first leg is clearly strong enough for a second leg. So if it's a really weak leg, it might just be a pullback, and you might end up being trading counter trend. You don't want to do that. Weekly chart, a bull bar, so consecutive bull bars. Maybe we go a little higher, but the traders who sold below here will probably be able to scale in and make money. This is bad follow through for this. So spike, pullback, and bull channel is starting. The monthly chart, a bull bar closing basically on its high. Probably, do I think we're going to get another big follow through bar? Do I think this next bar is going to look exactly like this? Probably not. And I believe that was actually the last chart. But I suppose, a brain exercise for you. Do you think we're going to 5,000 first or 7,000, right? So are we going up here or are we going here? Which are we doing first? Are we going to 6,600 or 5,500? Which one are we doing first? And you can kind of use that to start to think about your probabilities. What do I think? I think it's pretty tough because what I want to buy above this bar, not particularly. If the bulls can get one more good-looking bull bar, this might be a new bull breakout. Maybe we get up here. But the reality is I think we are going to end up touching this high, the October high. So I think we will pull back to here at some point, probably this month. All right, that is going to do it for the video for me today.